Hey everyone, it's Miss Queen Crypto. I am here today on the Embily channel in the first of many videos where I'll be covering a wide variety of topics from anything I'm particularly curious in and want to do a deep dive on to current events or like exciting news in the crypto sphere or any videos that you guys might want to see. So whether you're someone who's new to the space and you want to learn as much as you can, or you're someone who's a little bit more well-versed in the community but you just want to watch a fun little video, I am here for you, and I'm super excited about this opportunity. And so today we're going to be talking about KYC, which is Know Your Customer. And so the first time I ever heard KYC was at Bitcoin 2021, which was my first conference ever, and it was an amazing opportunity, and I was so happy to be there. But I was helping out with the Embily booth. And so a couple days before, the week before, they kind of briefed me on the main company policy, the hitting points, and what they expected the frequently asked questions to be. And for a majority of the customers or the people I talked to, that was perfect. I knew what I needed to know and I was able to answer all their questions. But a couple of people asked me about KYC from time to time, like, oh, does Embily have KYC? I was like, I don't know, do they? And so I deferred them to my cousin. I was like, I think he'll be able to answer your question for you. Because I figured it was something on the way more technical side of things, like Kraken or something that was just above my head. But after that happened, I was like, so what is KYC? I just don't know. And basically I was told that it's a form of verification so that the customer, when they sign up for an account, you can make sure that they're who they say they are. And that way you can hold them accountable for anything illegal that might be happening while their funds are in your custody. And so I was like, oh, that makes sense. And then I was like, oh, so when Gemini asked for a picture of my ID when I was making an account, that was KYC. I was like retroactively putting the pieces of the puzzle together. So whether you know it or not, you have definitely completed some form of KYC verification, whether you were opening a PayPal or a Venmo account, or a Coinbase or Gemini account, or just a traditional bank account. You've probably had to provide some form of verification for who you are, and that likely fell under KYC. And so since then, I wanted to do a little bit more research on the actual laws that govern KYC and what enforces it. And so basically, under the US Department of the Treasury, there are these two acts: the Bank Security Act and the Anti-Money Laundering Law. And so those two, in order to enforce, the Financial Crimes Enforcement Network, or FinCEN, was put into place. I'm going to call it FinCEN for the rest of, if I refer to it again. I know there's no H, we're just going to roll with it. But basically, FinCEN was tasked to make sure that financial institutions are held at least partially responsible for any illicit activity that might run through their custody or through their platform. And so in order to do this, they passed a law got a law passed that is the customer due diligence rule. They put out this rule. And in order to help institutions with this, there is also an accompanying program that's called the Customer Identification Program. So this was put into place in 2016, and pre-existing companies were given 2 years in order to comply with this law and to make sure that everything is like fitting right. They could get their ducks in a row. And so the requirements for this law, there are 4 main ones, or this rule. The first being companies must identify and verify the identity of customers. They must identify and verify the identity of the beneficial owners of companies opening accounts. They must understand the nature and purpose of customer relationships to develop customer risk profiles, and they must conduct ongoing monitoring to identify and report suspicious transactions, and on a risk basis, to maintain and update customer information. And so that's a lot. And upon first hearing these, the first thing that came to my mind was, I see some issues with the anonymity thing here, because that's such a core pillar of Bitcoin and other cryptos. The idea of a public ledger, but each of the transactions are anonymous so that you're protecting your individuality and it's private. And obviously that can't happen if you're going through these forms of verification that are tying you to your transactions. So that's the first big red flag for a lot of crypto users when they hear KYC. And I think that is the reason that I was getting so many questions about it, because people were genuinely curious. And so the verification process of KYC can include verification in the form of an ID, like your driver's license or a passport, face verification, like sending a selfie in, document verification, like sending in a utility bill or any other type of bill that ties you to the address that you say you're at, and then like biometric verification. But I think that one's a little bit less common. And so the Bank Security Act, I'm going to read this off, authorizes the Secretary of the Treasury to require financial institutions to keep records and files reports that have a high degree of usefulness in criminal, tax, or regulatory investigations or proceedings, or in the conduct of intelligence or counterintelligence activities, including analysis to protect against international terrorism. And so you hear that and you're like, okay, so that's what the risk profile is for, which that was a new thing to me. Whenever I had heard about KYC, I didn't know that these institutions had risk profiles on users. That was completely new to me. So I was like, what entails a risk profile? Like, what do the companies actually have to do? And apparently, this is a very, very common question, because when I went on to FinCEN's website to look up the actual law, there was a nice little CDD FAQs. And I was like, ooh, I love frequently asked questions. Let's dive on in. And 2 out of the 3 of them, they had like big paragraph responses, but 2 out of 3 of them were about the risk profiles. And so they said that money laundering, terrorist financing, and other financial crime risks of its customers must be monitored in order to develop customer risk profiles. And it's like, okay, well, does that mean that you have to place customers into high risk and low risk categories? No. Is there a spectrum that you kind of have to like be watching to make sure that they don't go too far to this side? No. So it's a very variable thing. It's very open to interpretation for the actual institution to decide, but the long and short of it is you just have to make sure that nothing suspicious is going on, or if something suspicious is going on, you might want to pay closer attention to them. Makes sense. And so there is a requirement to update customer information, and that's risk-based, and it occurs as a response of normal monitoring. And so the best example of that I can think of is, say you have a customer who opened an account a year ago, and month to month you have a pretty consistent pattern of depositing and withdrawing funds, and it's pretty predictable from month to month. And then all of a sudden they get a wire transfer of $1 million. I think that would raise some red flags. I think you'd be like, this seems out of the ordinary. We might want to look further into this. And so that's basically what they want these financial institutions to do in order to monitor and see if anything a little bit odd is going on. And so you might wonder, okay, so what do they do if they decide someone is high risk? And again, lots of people had this question, but even within the same risk category, there might be a spectrum of risks that are identifiable, and due diligence measures vary on a case-by-case basis. So basically, the institution itself is given a lot of autonomy to make sure to identify and report anything that they deem as suspicious that could be related to money laundering, terrorism, or like tax evasion, any sort of like money crime. But again, we run into issues with a lot of the core principles of Bitcoin and why so many people are drawn to Bitcoin and crypto versus other fiat traditional banking systems. And part of that is the autonomy, being able to be your own bank and not have to succumb to any of those regulations, and being able to like have custody over your money yourself. And so this doesn't really apply to like a wallet that you might have, like a cold storage wallet, but this has to do with like the spending of it, like transferring it into an account to then spend it. And so it's meant as a safety precaution for users on the platform, and it's meant as a way to try and prevent any sort of money crime from happening. Because a couple of years ago, like when FinCEN was being like produced, when they were in the works, the US Department of the Treasury did a study, and they estimated that like $300,000 or $300 million a year, sorry, my bad, $300 million a year were involved in just illicit behavior, like terrorism, crime, all that. And so they deployed FinCEN to try and reduce that. And they said that even if they reduced the amount of money crime by 0.5%, then their efforts would be worth it. And they expected it to decrease by a whole lot more. And so I think that I mean, at least before I became super involved in Bitcoin, I remember the main narrative being pushed whenever I would hear about it being that Bitcoin is only for criminals and terrorists. Like you use Bitcoin to buy things on the dark web. That's it. No one uses Bitcoin for like good reasons. And I'm sure that that deterred a lot of people from doing their own research or getting involved, especially early on. And I think that that was a large barrier to get through in order to move towards mass adoption, which is hopefully something that we all really want. Like we all want Bitcoin and crypto to be able to be used as legal tender because we see it as a superior form of money compared to fiat. And so moving towards mass adoption and making sure that we can comply with these national and international laws is a very important step towards that adoption. And so it's about making a safe environment for the users and making sure that we're abiding by these regulations, but also kind of bridging traditional banking systems and fiat with cryptocurrency. And that's a huge step towards making people more comfortable and making it a bigger deal than it already is. And so while we might not be the biggest fans of having to upload our ID and have our funds be monitored, it's an important thing, and we really don't have a choice, crazy enough. But that's the long and the short of KYC. Thank you guys so much for watching. If you enjoyed this video, leave it a like, subscribe, and follow me on Twitter at MissQueenCrypto, and I'll see you guys next week. If you have any further video suggestions, please leave them in the comments, or you can DM me on Twitter. But I'll see you guys soon.